Have you ever seen a massive economic number get released, and the market does the exact opposite of what you'd expect? Well, that's because the pros, they aren't trading the headline. In this explainer, we are going to unpack the systematic framework they use to process macro data and really get to the bottom of why assets reprice the way they do. And this right here is the core philosophy. You absolutely have to get this. Asset prices are a reflection of future expectations. We're talking about growth, inflation, and policy, not what's happening in this exact moment. The market is always trying to skate to where the puck is going to be. So, here's our game plan. We're going to start with what the market already has baked in, then we'll look at the surprise that actually gets things moving. After that, we'll run it all through the central bank's brain, trace the ripple effects across all the asset classes, and finally see how this one piece fits into the entire macro puzzle. All right, first up, what is already priced in? Before a single piece of data even comes out, the market has a baseline, a story it's already telling itself about the economy. The real game isn't about that one data point. It's about how that data point changes the entire plot.
So how do we actually see that baseline? Well, it's a mix of things like consensus analyst estimates and how investors are positioned. But the really critical information, that comes from the derivatives market. Things like Fed funds futures and OIS curves, these are basically swaps that show the market's hard money bets on where interest rates are headed. This gives us a precise probability map. This is our starting line.
Okay, now for the most critical part, the signal. This is the catalyst, right? It's the input that kicks the whole repricing machine into gear. And it's not the headline number itself, it's how much that number deviates from what everyone was expecting. And this slide says it all. The delta versus consensus. Honestly, that's the only thing that really matters. A 200,000 jobs number means nothing if the market was looking for 199,000. But if the market expected 150,000, that 50,000 surprise is a huge signal that forces everyone to immediately rethink the future path of policy. Let's take a non-farm payrolls report as an example. The retail read is simple. A strong headline must mean a strong economy. But the institutional read, it's way more nuanced. They're digging in, asking, what about wage growth, the average hourly earnings? And were the previous month's numbers revised down? You see, a big headline number with weak wages and negative revisions, that can actually be read as disinflationary, which completely flips the script on rate expectation. And it's the exact same deep dive for inflation. Yeah, the year-over-year number gets all the headlines, but the pros? They're laser-focused on the month-over-month momentum. Is the trend still intact? Or price pressures showing up everywhere? Or are they just isolated in a few spots? And here's the most important question of all. Does this new print confirm or totally contradict the Fed's story on inflation? So, we've got our surprise. Now what? How does the market process it? Well, this is where the central bank filter kicks in. Every single piece of data is viewed through one single lens, and it's asking one question. How is the Fed going to react to this? And you've got to remember, the Fed's sensitivity isn't static. It's working with a dual mandate. Sometimes, like during a post-pandemic recovery, their focus is almost entirely on sticky inflation. But other times, when inflation is cooling, their sensitivity can shift completely over to any weakness in the labor market. You have to know which mandate they care about most right now. This table breaks down that direct link between the data and the policy path perfectly. Sticky inflation, or a hot jobs market, means the Fed is probably going to keep rates higher for longer, maybe even hike again. That tightens financial conditions by pushing up real yields and strengthening the dollar. And, of course, the exact opposite happens with any signs of disinflation. Okay, so this brings us to the cascade. Once the market reprices what it thinks the Fed is going to do, a totally logical and pretty predictable ripple effect, a cascade, flows right through every other major asset class. Here's a classic example. Let's say inflation comes in hot. The market instantly pushes out the timing and the number of expected rate cuts. What happens next? Real yields pop higher and the dollar strengthens. And the immediate impact of that? The valuation multiples for growth sectors like tech get squeezed hard. It's a clear four-step chain reaction. Bonds are always the first responders. An upside surprise in inflation or jobs will cause a sell-off, especially at the front end of the curve, which is super sensitive to Fed policy. That pushes real yields higher. A downside surprise does the opposite, often sparking a rally we call a bull flattener, where long-term bond yields fall faster than short-term ones because the market is pricing in slower growth ahead. From bonds, the wave hits the FX market.
And this is almost entirely about interest rate differentials. If US yields are rising faster than yields in Europe or Japan, capital just floods into the US to chase that higher return, and that strengthens the dollar. Disinflationary data, on the other hand, weakens the dollar, which then acts as a tailwind for other major currencies.
Now, for equities, the impact is really twofold. First, like we saw, higher real yields act like gravity on the valuation multiples of growth stocks. It just pulls them down. Second, it drives sector rotation. An inflationary surprise usually favors value, cyclical, and energy stocks, companies that can pass on higher costs, while disinflation tends to benefit those duration-sensitive tech names. And finally, we have commodities, which get caught in this constant tug-of-war. Strong economic data signals healthy demand, which is great for things like industrial metals and oil. But that same data usually leads to a stronger US dollar, which is a major headwind for anything priced in dollars. Gold, though, it's a special case. It's almost exclusively focused on real yields, and it rallies when they fall. So we've traced the entire journey of a single data point. But the real institutional game, it's about zooming out and asking the bigger question. How does this one data point fit into the broader, multi-month macro narrative? And this is where we have to think about market structure. How are the big systematic trend-following funds, the CTAs, positioned? A surprise that goes against them can trigger a flood of automated orders. Then you've got dealer gamma exposure from the options market, which can force dealers to buy into a rising market or sell into a falling one, just exaggerating the move. This is exactly why that initial knee-jerk reaction, which usually happens in thin liquidity, is often an overshoot, a mispricing, before the real institutional money steps in. And this right here, this is the ultimate takeaway. Markets do not trade noise. They trade the signal. They are constantly testing hypotheses about the economy. So the only question that ever matters is this. Does this new piece of data confirm or does it contradict that prevailing regime? And that regime, it's built on these key pillars: the trajectory of inflation, the stage of the growth cycle, the Fed's constantly evolving bias, and, of course, how all of this stacks up against what other central banks are doing around the world. A single data print is just one brick in this much, much larger wall. At the end of the day, understanding this entire framework, from that initial surprise through the central bank filter and across the whole asset cascade, this is the absolute foundation for how institutional portfolios are run and how massive amounts of capital get allocated on a global scale. So, the next time a big number hits the wires, don't just glance at the headline. Instead, ask yourself this: how does this surprise change the market's expectation for policy? And even more importantly, does it confirm or does it challenge the entire macro regime?